Today we're going to talk about the typical problem that banks face related to investments. So let's take a look at our example. This bank had loaned $20 million to a cement factory, and the factory gets into financial trouble, and the bank takes over and appoints a consultant to find some solutions. After careful review, the consultant recommends several options. Option 1, invest an additional $8 million. However, he determines that the likelihood of a successful turnaround recovery is about 65%, and the benefits would be you would get back your $20 million in full payment plus a $5 million bonus. However, if not successful, that would be a total loss with bankruptcy and only salvage value from whatever we can get rid of. The option 2 is basically do not invest. But there are consequences. They estimate that there's a 30% chance a competitor might acquire the company. And if they do so, they'll acquire it for about $5 million, but there's a high percentage chance of success, 80% chance of success, because they know the business. And they agree to pay the balance, $15 million, if they succeed. But if they fail, there are no obligations, they just lose the $5 million. There's also a 30% chance that the government might forcibly acquire this factory to provide employment for the town. And they too feel they have a 50% chance of success. And if they succeed, they will pay the debt. As in the previous case, if they fail, there are no obligations. And the final likelihood is that if neither of the above come across, they have to file for bankruptcy and then sell the assets. And they estimate that there's a 50-50 chance they might recover $8 million or just $4 million. So what options do we have? Invest or do not invest, right? Any proposal that we make must be approved by the bank's board. Hence, it must be defensible. Here is the decision tree that represents the problem that we just discussed. Should we invest or not? Here are the options. Do not invest, invest. So if you do not invest, there are consequences, as you can see, as we discussed earlier. And if you invest, there's still a 35% chance that there would not be any recovery and you would have to go for bankruptcy. But that's a chance. So let's see what we need to do. Let's go to our decision zone map. Here we see that the pointer at this level is a 30% and the 65% chance. It says to invest. However, if management were to start discussing this issue further and they feel that the 65% is highly overestimated, they drop it down and see what happens when it goes below 46%. It says do not invest. So the advantage of a map like this is it allows you to have a discussion on the uncertainties associated with this type of decision.